Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we're going to explore a topic that sits at the heart of financial markets, but is often misunderstood, and that's volatility. Whenever markets become turbulent, financial media tends to explain the moves with a single word: fear. We hear phrases like investors are fearful, markets are nervous, or risk sentiment has deteriorated. While fear certainly influences market behavior, it doesn't tell the whole story. In fact, if you want to become a better trader or investor, you need to move beyond the simplistic idea that volatility is merely a measure of panic. Today's discussion is all about understanding how volatility changes across different macroeconomic environments, often referred to as volatility macro regimes. More importantly, we're going to focus on understanding volatility beyond fear and examine the deeper economic forces that drive market fluctuations. By the end of this episode, you'll have a much clearer framework for interpreting market movements and understanding why volatility behaves differently depending on the broader economic backdrop. Let's begin by defining volatility itself. At its core, volatility measures the magnitude of price changes over a given period. When prices move dramatically up and down, volatility is high. When prices remain relatively stable, volatility is low. Now, many retail investors view volatility as something negative because it's often associated with market sell-offs. However, professional traders tend to view volatility differently. Volatility isn't inherently good or bad. It's simply a reflection of uncertainty and changing expectations. In fact, without volatility, there would be very few trading opportunities. Markets need movement for traders to generate returns. The key question is not whether volatility exists, but why it exists. And that's where macroeconomics comes into the picture. Financial markets don't operate in isolation. Every stock, bond, currency, commodity, and index exists within a broader economic environment. That environment influences investor behavior, capital flows, risk appetite, and ultimately price movement. This broader environment is what we call a macro regime. A macro regime is essentially a combination of economic growth, inflation, monetary policy, and liquidity conditions. Different combinations of these factors create very different market environments. This is why studying volatility macro regimes is so important. The same economic data point can trigger completely different market reactions depending on the macro regime in which it occurs. Generally speaking, there are four primary macroeconomic regimes that investors monitor. The first is low growth and low inflation. The second is high growth and low inflation. The third is high growth and high inflation. And the fourth is low growth and high inflation, often referred to as stagflation. Let's walk through each one and discuss how volatility behaves in these environments. We'll start with low growth and low inflation. This environment is often characterized by accommodative central bank policy, low interest rates, and abundant liquidity. Inflation remains subdued. Economic growth is relatively stable, and policymakers typically support financial conditions. When borrowing costs remain low and liquidity is plentiful, investors generally become more comfortable taking risk. As a result, market volatility often stays relatively low. Many investors associate this environment with stability. Asset prices tend to rise steadily, and risk assets often perform well because the overall backdrop is supportive. A good example would be much of the period following the global financial crisis, when major central banks around the world maintained highly accommodative monetary policies. But here's something important to remember. Low volatility does not necessarily mean low risk. In fact, extended periods of low volatility can encourage excessive risk-taking. Investors become comfortable, leverage increases, asset valuations rise, and when markets become too comfortable, they can become vulnerable to unexpected shocks. Ironically, some of the largest volatility spikes in history have emerged after long periods of calm. Next, let's move to what many investors consider the ideal environment: high growth and low inflation. This is often called the Goldilocks regime. Economic growth is strong. Businesses expand, employment rises, consumer spending remains healthy, corporate profits improve. At the same time, inflation remains under control. This combination creates a very favorable backdrop for financial assets. Volatility often remains moderate because investors have confidence in both economic growth and monetary stability. Equity markets frequently perform well during these periods because earnings growth becomes the primary driver of valuations. However, volatility never completely disappears. Markets are forward looking mechanisms. Investors aren't simply reacting to current conditions, they're constantly trying to anticipate future developments. For example, if growth begins accelerating too quickly, market participants may start wondering whether inflation pressures are building beneath the surface. Suddenly, what appears to be positive economic news can create volatility because investors begin reassessing future risks. This is one of the best examples of understanding volatility beyond fear. Volatility doesn't always emerge because investors are scared. Sometimes volatility increases because investors are recalibrating expectations about what today's data means for tomorrow's economy. Now let's move to the third regime: high growth and high inflation. This is where things become more complicated. Initially, strong growth remains supportive. Businesses continue generating profits. Employment remains healthy. Consumers continue spending. But rising inflation changes the equation. As inflation accelerates, central banks become increasingly concerned about overheating economies. Policymakers may begin discussing tighter monetary policy. Interest rates may rise. Liquidity conditions may tighten. And suddenly, investors face competing narratives. On one hand, economic growth remains strong. On the other hand, inflation introduces uncertainty about future policy actions. This uncertainty often creates higher volatility. Markets become increasingly sensitive to inflation reports, employment figures, consumer spending data, and central bank communications. Every new data release can alter expectations regarding future interest rates. Bond markets may react sharply. Equity sectors may rotate aggressively. Currencies may experience larger swings. Commodity prices may become more volatile. This environment often produces substantial cross-asset volatility because investors are continuously reassessing the balance between growth and inflation. The fourth and often most challenging regime is low growth and high inflation. This is commonly known as stagflation. Among all volatility macro regimes, stagflation tends to be one of the most difficult for investors and policymakers alike. Why? Because policymakers face a dilemma. If they lower interest rates to stimulate growth, they risk worsening inflation. If they raise rates to combat inflation, they risk slowing the economy even further. There are no easy solutions. This uncertainty often translates into elevated volatility across financial markets. Stocks may struggle because earnings expectations weaken. Bonds may face pressure because inflation remains elevated. Consumers become more cautious. Businesses reduce investment spending. Investor confidence deteriorates. The result is often prolonged market uncertainty and sustained volatility. Historically, stagflationary periods have been among the most difficult environments for traditional portfolios to navigate. Now, as we've discussed these different regimes, one theme keeps emerging. Volatility is not simply fear. And this brings us to perhaps the most important lesson of today's episode. Understanding volatility beyond fear means recognizing that volatility is often a reflection of changing expectations. Markets are constantly processing new information. Investors are continuously updating their views regarding economic growth, inflation, monetary policy, corporate earnings, and liquidity conditions. For example, imagine a stronger than expected jobs report is released. At first glance, that sounds positive, yet markets might become highly volatile. Why? Not because investors are afraid, but because stronger employment data may increase expectations for future interest rate hikes. In other words, volatility emerges because investors are adjusting expectations. This distinction is incredibly important for traders. If you view every volatility spike as fear, you'll miss the deeper forces driving market behavior. Successful traders understand that volatility often represents adaptation rather than panic. Let's also spend a few moments discussing the role of central banks because they are among the most powerful drivers of volatility in modern financial markets. Central banks influence borrowing costs, liquidity conditions, economic growth, and risk appetite. When policy remains predictable, markets often remain relatively stable. But when policymakers unexpectedly shift direction, volatility can increase dramatically. This is why professional investors spend enormous amounts of time monitoring central bank statements, inflation reports, economic forecasts, and policy guidance. Markets aren't simply reacting to what central banks do today. They're reacting to what investors believe central banks will do tomorrow. This forward looking nature is one of the key reasons volatility exists in the first place. So, how can traders adapt to changing volatility regimes? The first step is monitoring economic indicators closely. Pay attention to GDP growth, inflation reports, employment data, manufacturing surveys, consumer spending figures, and central bank announcements. These indicators often provide early clues about potential regime changes. Second, adjust position sizing appropriately. Higher volatility environments generally require more conservative risk management. Smaller position sizes can help traders manage uncertainty more effectively. Third, diversify across asset classes whenever appropriate. Different assets respond differently to changing macro conditions. Diversification can help reduce concentration risk and smooth portfolio performance. And finally, remain flexible. Markets evolve constantly. Economic conditions change. Monetary policy shifts. Investor expectations adjust. The traders who adapt successfully are often those who remain open minded and willing to update their views as new information emerges. Before we wrap up today's episode, I want to mention a valuable resource for traders looking to navigate changing market conditions with greater confidence. The Crystal Ball Markets platform provides a cutting edge, user friendly trading experience designed to help traders analyze markets, monitor risk, and make informed decisions in fast moving environments. You can learn more by visiting crystalbellmarkets.com/platform. And if you're interested in continuing your education on trading, investing, macroeconomics, and financial markets, I highly recommend checking out the Crystal Ball Markets podcast. It's designed to be beginner friendly while still offering valuable insights for more experienced market participants. You can listen here at rss.com/podcast/crystalbellmarkets. As we conclude today's discussion, remember this: volatility is not merely a measure of fear. It's a reflection of changing economic expectations, shifting policy outlooks, evolving growth forecasts, and ongoing market adaptation. By understanding volatility macro regimes and focusing on understanding volatility beyond fear, traders can develop a more sophisticated perspective on market behavior. The goal isn't to avoid volatility. The goal is to understand it. Because the better you understand why markets move, the better equipped you'll be to manage risk, identify opportunities, and make more informed trading decisions. Thank you for joining me for this episode of Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.